Absolutely delighted to be here to talk to you today. I'll start off, first of all, with a bit of an introduction to British Land. And whilst many of you will be familiar with us, we are, by way of introduction, a FTSE 250 real estate investment trust, founded all the way back in 1856. And today we have £14.6 billion worth of assets under management and a net asset value of around 5.7 billion. And to give you some sense of scale, in a typical year, we'd lease around 3 million square foot of space, and our portfolio is currently 98% occupied. In terms of strengths for the business, whilst there are many real estate investment trusts out there, we like to think that we have 5 key strengths as a business. That is that we've got a portfolio of high quality UK-based assets. We've got a team with deep development expertise, particularly in the London space. We've got a strong balance sheet to take advantage of opportunities as they arise. We've got a best-in-class platform to fully manage the life cycle of property assets. We're very active with our properties. And finally, we've got strong partnerships with world-leading sovereign wealth funds and pension funds who co-invest alongside us. And it's so through those strengths that we operate our business model of a value-add active approach. And we do that by sourcing value-add opportunities, either internally from within our own portfolio or externally purchasing them. We then look to develop or otherwise actively manage them to generate returns in excess of the wider property market, before recycling that capital from mature assets into new higher returning opportunities. And it's through that approach that we aim to generate an income-focused 8 to 10% total accounting return, or in effect, a return on equity through the property cycle. Now, for us to deliver that target return, we're invested in 2 main segments. And for the purpose of time today, I'll focus on our 2 main property classes, being campuses, and those are office-led London-based estates, which make up about 58% of our assets, and then retail parks around the UK, which make up 32% of our asset base. Now, we focus on those sectors because we believe they have the strongest occupational fundamentals, and that is the space that occupiers most want to be in. And we'll come on to both of those 2 sectors in a little detail later on. In terms of our biggest occupiers, our customers are blue chip names you'd recognise on the retail side. The likes of Next, M&S and Boots are some of our biggest customers. And then on the campuses side, we provide high quality UK headquarter space to technology professional services and financial firms, mainly in London, as I've said. So before I take a bit of a deeper look into campuses and retail parks, I'll just touch on how the business has performed for the year ending 31st of March 2025. We've seen good continued operational and financial momentum, and we've leased well across the business 9% of value as estimated rental values, which together with good cost discipline and successful asset management means that we've managed to grow our underlying profit by 4% and maintained our earnings per share despite significant development activity across the portfolio. And it's of course that development activity which is a key source of future earnings and capital growth for the business. Over the year, values were up 1.6%, driven by rental growth in the portfolio of almost 5%. And encouragingly, our campus values passed an inflection point, with values increasing in the second half. We're seeing strong fundamentals in our key markets, and that gives us confidence for the future. Here we're seeing return to the office in full swing in London, and retailers are competing aggressively for space on our retail parks around the UK. And supply in both of those markets remains very constrained. We've also continued to deploy capital into those 2 markets in the year by committing to new developments at 2 Finsbury Avenue and refurbing Broadgate Tower, both on our Broadgate campus in London, and investing over £700 million into new retail park acquisitions in the year. So from a financial perspective, we generated £279 million worth of underlying profit for the year. And with our policy of paying out 80% of those earnings as a dividend, that brought our dividend payout to 22.8 pence. From a balance sheet perspective, our properties are fair valued every 6 months, And taking the latest valuations into account, our net tangible asset per share was 567 pence as at the balance sheet date. It's about a 30% discount from where the share price sits today. We make appropriate use of debt and therefore are moderately geared with a 38.1% loan to value ratio. And with the valuation growth we delivered in the year, we delivered a total accounting return of 5% overall. This slide just quickly covers the valuation movement that we saw in the year in greater detail, and I won't run through all the detail, but we've just to pull out 2 points. We've already mentioned that we saw campus values inflecting with a positive 0.8% increase in the second half of the year. But it's worth noting that retail parks in particular had a really strong year, and this might be in contrast to what some are expecting when you hear about the macroeconomic environment. But we saw 7.1% valuation growth on the retail park portfolio, as both occupiers and investors were attracted to this compelling format. We'll come on to that in a bit more detail shortly. So moving on to our two main property classes in a bit more detail, let's talk about what we mean when we talk about a campus. Well, there's no one definition, but we think of it as an estate where we control the space, so the buildings and the space around them, and that we have a number of characteristics that allows us to call an area a campus and drive value out of that. First of all, the buildings themselves offer best-in-class, high-quality workspace. It's really the prime end of the market where top occupiers want to be. Secondly, we control the public realm around the buildings as well. So the public realm is inviting, people want to spend their time there, go outside, have a bit of lunch and other things. Linked to that, there's also great retail and amenity offerings around the campuses. So they'll have bars, gyms, places to go get lunch, a lot there other than just workspace. Fourthly, they're located next to key transport hubs. Quite often, our campuses are literally on top of key transport hubs. And that means that occupiers like being there because their employees have a more straightforward journey to work. We also make sure that our buildings are sustainable, and whether that's through operating efficiently in terms of lowering carbon emissions associated to the day-to-day operations, but also when we're doing redevelopments, making best use of recycling and reusing materials as possible. And then the final offering from our campuses is that we tend to offer flexible workspace throughout. We have a flexible workspace offering called Story, which operates on all of our campuses. And we think that's something that customers really value. I know Georgina mentioned that workspace were having a bit of a tough time at the minute. That would echo with our views of flexible workspace in the wider London market. But we find that it really brings an additional offering to our campus offer where we obviously control the space and have a monopoly. And it's because of all those attributes around the campus workspace that 80% of our workspace is let as UK headquarters to occupiers, predominantly in London. In terms of our main campuses, we've got 4 across London. I can't go into a huge amount of detail on each of them, but taking them pretty quickly. On top of Paddington Station, pretty much, Paddington Central, 11 acres to the west of London. At Regent's Place, just north of Oxford Street and below Regent's Park, we've got 13 acres of space in what is called known as the Knowledge Quarter of London, surrounded by University College London, the Crick Institute, British Library, and others. In the heart of the City of London, we own Broadgate, which is the 32 acres of prime London buildings, where we're seeing a number of professional services firms, financial firms located there. And at Canada Water, to the southeast of London, our newest campus, comprising 53 acres of Zone 2 space, is just starting to take shape, with the first phases of that development completing as we speak. And so what's the outlook really for campuses from our perspective? Well, if you cast your mind back to April 2020, average utilisation of our campuses was about 5% of the pre-COVID levels, as this graph shows. And some were predicting the end of office space as we knew it. But fast forward to today, and we would say that return to the office is very much in full swing. Occupancy and utilisation of our buildings on our campuses from Tuesday to Thursday is back up to pre-COVID levels. Monday is increasingly closing the gap on the middle of the week, though it's probably safe to say that Fridays will stay a little bit quieter into the future. So what does this return to the office trend mean for our portfolio? Well, supply in London is really very constrained, particularly in the city, where you can see on the graph on the left-hand side of this slide that we estimate a 5 million square foot shortfall of new or substantially refurbished space by 2029 versus demand. And as a result, that means rents are growing strongly. At Broadgate, for example, we've seen asking rents at 2 Finsbury Avenue increase by 10 to 15% since we agreed a £100 per square foot pre-let deal last year. And Cushman & Wakefield are forecasting rents for this type of space to grow by a further 8% per annum to 2028. And because supply for new space is in such short demand, existing space in central London locations is increasingly sought after and availability is declining. Availability of existing stock in the city has declined by 21% since 2023, and availability of sublet space has declined by 66% since the peak in 2021 to an all-time low today. And that ultimately means rents are increasing. And you can see this on the right-hand side of the slide, which shows our recent deals on existing space at Broadgate, which has really accelerated over the past few years. And it's this strong supply-demand dynamic, which means we've got confidence that rents will continue to grow by 3 to 5% per annum over the medium term. And that's good for future earnings growth, but it's also good for the future valuations of our campuses, which are derived from their rental cash flows. So that's campuses. Moving on to retail parks. We own 54 parks all over the UK, as you can see here on the map. These parks are typically 15 to 20 unit open air parks, well located on main arterial routes with free car parking. And we're the largest owner and operator of large retail parks in the UK, which obviously gives us a competitive advantage. So why do we and many retailers prefer the format of retail parks over other retail formats? Well, it's the affordability, accessibility, and adaptability of parks, which means a wide range of retailers are competing for space, leading to competitive tension. And you can see in stark contrast to the high street and shopping centres, there's actually been a net increase in new store openings at retail parks over the past 8 years. We're obviously seeing some challenges for retailers coming through increased costs and changes to employment law, but we actually think that's likely to accelerate the shift further from the high street and secondary shopping centres to retail parks and what is effectively a far more cost-efficient format. And it's this competition for retailers for space which is driving up rental growth on our parks, which was up 6% in FY25. So looking ahead, this rental growth, together with attractive yields on retail parks, limited capital expenditure, makes retail parks a conviction sector for us, which is why we spent a further £700 million acquiring 15 more retail parks this year. And where we can buy assets yielding 6 to 7% with 3 to 5% estimated rental growth on top, that generates us double-digit returns and has led to retail parks being the best performing UK real estate subsector over the past 4 years. So moving now on to the outlook and summing up. As I mentioned earlier, we target generating 8 to 10% total accounting returns over the medium term. This target is income focused, with 5% of that total returns delivered by the expected underlying profit of the business today. And looking ahead, we identify 5 levers to deliver profit growth into the future. Firstly, like-for-like rental growth, i.e. generating more from the standing assets that we have today. Secondly, leasing up our developments, which is predominantly on the campus side of the portfolio, where we're delivering best-in-class new space into London. Keeping a rigorous control on costs, that means the operating costs of the platform that we operate, but also mitigating any rises in interest rates and financing costs. Fourthly, through continuing to actively recycle capital, we can take capital out of lower yielding assets and reinvest into higher yielding opportunities. And finally, linked to that, we can increase our fee income through bringing in more joint venture partners and generating attractive fees off the back of that. We're very much focused on each of those as a management team, and we understand the importance of income and ultimately dividends to our investors. Our focus on our 5 levers of earnings growth translate into the capital priorities you can see on the slide here. At our campuses, we'll continue to recycle out of mature assets into super prime developments, bringing in partners to accelerate delivery and earn valuable fees. And we'll continue to grow our retail park business, provided we can do so at attractive yields and below the replacement cost of those assets, importantly. So to finish up and before going to questions, I'd just like to end on our investment case, which gives us confidence for the future. In our view, we're in markets with strong occupational fundamentals, and we create additional value through our development and asset management in a value-add approach. And with a portfolio yield of 6.1% today, strong rental growth prospects of 3 to 5% per annum into the future, and development upside, we remain well placed to deliver attractive returns going forward. So thanks very much for listening, and I'm very much looking forward to taking your questions.
Yes, Jonty, really interesting. Thank you very much indeed. I interviewed Stephen Hester when the company went into REIT status, one of the first businesses to do so back in 2007. And I really wanted to kick off in the wider context and talk a little bit more about the long-term outlook. One of the final questions we gave to Georgina was about the wider economic cycle and the threats from excessive public indebtedness and slowing growth. Just contextualize where the company is at the moment. Share price at 386. Just before the financial crisis, it was something like £13.50 or something. Just contextualize where you are and what the hopes were back in 2007, and whether or not REIT status does really pay off for companies like British Land.
Yeah, it's a very good question, Jeremy. Thank you for that as an initial one. And I think that, the REIT regime is an attractive structure for UK real estate. In effect, there's a number of rules around it, but in effect, in return for companies paying out 90% of their profits to shareholders, it means that the entity doesn't pay any corporation tax. So that is obviously a very attractive offering. And that then means that shareholders, retail shareholders, act as if they own the properties themselves, and they're receiving tax-free income that then taxed in as if it's property income. And institutional shareholders are receiving an income that is subject to no corporation tax. We still think that's a very attractive offering, and it makes sense for us as a business. There is some distraction that comes from the fact that you're having to pay out a large amount of your recurring earnings and limiting reinvestment back into the business. That's something that we try and address through making sure we're being very thoughtful about where we allocate capital and making sure that we're very disciplined in the way that we do that. But as you've said, the share price was back up at £13 during pre the GFC. We've obviously come a long way since then. But what I would say is the healthy dividend yield that we are paying out means that shareholders are being paid to be on the shares. So that 8 to 10% total accounting return that we're looking to generate as a business, from where we sit today at about a 30% discount to our net asset value, we feel very comfortable about giving that guidance for the medium term as we look forward with yields now stabilised.
Absolutely. One of the follow-up questions to that is one that's come through. What kind of risks or opportunities could affect the kind of growth you're talking about over the next 5 years? I think we're saying something like around about tripling in share price through to 2030. This questioner wants to talk about the risks you perceive in future growth.
Yeah, definitely. So I suppose from the opportunity side of things, I think the fact that supply is so limited in the two markets that we operate, that's the opportunity. And really it's strong rental growth continuing to come through that will drive the future performance of the business. So that's the main opportunity side. On the risk side, what could disrupt that is UK macroeconomic factors. In effect, that London as a heart goes into a significant severe recession, and something similar for the UK consumer around the country. I think what we've seen is, whilst the UK has had challenges, people in London are still going out and still spending money. People around the UK, Georgina was talking about saving rates being the highest they've been for a number of years. People are still going out and spending. So I think for us, because we're an active manager, it's about picking the subsectors and picking the properties that are in the right part of the markets to limit any potential downside risk.
Staying along this sort of line, another question's coming. Do you have any quantitative impact of lower interest rates on free cash flow per share or earnings per share for 2025?
Yeah, so when you say lower interest rates, so interest rates, I suppose, have come down a wee bit, but in terms of how we hedge and our debt, we effectively hedge our debt over a 5-year period, and that means that we're pretty fixed in the near term. So typically, the next 12 months will be almost up to 100% hedged and fixed, and then at the lower end, at the end of the 5 years, we would be more floating. So for us, there's not a huge benefit coming straight through from significant movements in interest rates, mainly because we're looking to hedge out the risk associated to that. But what you will see is in time is that we will revert to market rate in terms of our debt and finance costs. So lower rates is something we will benefit from over time, but it's not something that you'll see huge volatility in our earnings from one year to the next.
Yeah, staying on the interest rate picture, another question coming. Given the interest rate sensitivity of REITs, which is something you talk about, and higher interest rate environment, higher again, it depends on context, but let's say 4.25% at the moment. What factors will narrow the 30% gap to net asset value, NAV?
Yes, yeah, and so we think about interest rate in the business using a 5-year SONIA swap in effect, and so that sits at about 3.9% today, and that's typically what we use to fund the business. So we're looking ahead saying, well, with the portfolio as it is, with 5-year swaps at around 4%, and obviously there's some hope that interest rates may drop lower than that, and that's great if it happens. We're setting the business up to succeed from here. So that's very much the way we're looking to ensure that we're set up for best success in the future. In terms of the 30% discount to NAV that we have, I think what we'll see that close is when we get some liquidity back in the London office market. And by that, I mean big institutional investors, perhaps pension funds and others, people from around the world coming back and investing in scale in the London office market. That has been a bit quiet of late over the last 24 months. But once we see that come back, that could push down yields on property values and drive valuations forward.
Yeah, let's pick up on that point about the London market. Another question that's come through suggests that given your presentation this morning, it's clear that there's a relative London centricity to the spread, perhaps maybe that's the right way of putting it. Are you considering any other cities? The questioner suggests Birmingham, given the HS2 extension, assuming that all gets completed. There are other opportunities. This levelling up is providing all sorts of opportunities for companies to expand outside of London, getting better opportunities for expansion, and of course at a relatively more expensive rate than you would get in London. How do you see the dynamic of the UK-wide property market so far as your portfolio is concerned?
Yeah, no, that's a very fair question, and there are plenty of opportunities outside of London, around the UK. So we do have small parts of our holdings on the offices side in Oxford, in Cambridge, and in Guildford as well. So we operate effectively in the Oxford, Cambridge, London triangle, where we typically purchase assets. There are opportunities in other places like Birmingham, Leeds, Manchester, all thriving cities. I think what we tend to look for are areas where we have a right to win, in effect, and by our nature and the way that we've come about as a company, we have significant development expertise in London, and that involves the relationships that we have with local councils, with the mayor's office and others, and so that's where currently we see the best returns going forward. But we certainly take a look at everything. And if we get to an environment where we can purchase properties with decent yields, see attractive returns into the future, we'd always consider it.
And of course, that question to some degree leans on this idea that perhaps maybe there might be a change in your spread between campuses, retail, smaller retail. Are you satisfied with the spread of what you've got? You talk about campuses being the lion's share and the retail parks being something else which is up there with the biggest. Are you happy with the portfolio spread at the moment, or do you think there could be a better dynamic opportunity out there if you shift some of your emphasis away, perhaps maybe from some of those areas where there is already a large exposure?
Yeah, I think we've consistently said that we would look to downweight on our mature London office assets, and that's simply because once we've built a building, let it up, and we're getting on to just what is a standard building going out 5-10 years, there's limited value that we can add, and therefore that's the time for us to move those assets on, sell them to others with a lower cost of capital, and reinvest into high yielding opportunities. So as a portfolio mix, over time, I would expect us to downweight on the campuses side and reinvest into, at the minute, predominantly retail parks, as well as some of our super prime developments. So could I see us in 12, 18 months time having a slightly greater weighting towards retail? I think that's fair to say.
And you think you're talking there specifically about retail parks, are you? Would British Land be interested in new construction, for example, if you were able to get a new site, or are you just looking to acquire an up and running opportunity?
So at the minute, retail parks we think offer the most attractive opportunity. I think there's a number of interesting adjacencies to retail parks which we would consider. We're certainly not limited in terms of our investment thesis. We've got the ability to stretch out from that if we think we've got the right to win in that particular space. The reason why we wouldn't be looking to do significant retail park development or significant retail is you can currently buy retail parks and other retail assets well below their construction replacement cost. And that's simply a mechanics of the fact that retail rents have significantly rebased from perhaps 2015, 2016 due to the impact of online shopping and online penetration. So for us, it makes sense to buy them at the minute.
Yeah. And finally, one last question has just come in. What does liquidity look like for recycling lower yield properties? You just mentioned yields and where you like to see them. Do you have any sort of clues as to what you think in this regard for these lower yield properties?
Yeah, I suppose in terms of what we sell in a typical year, if you look back over the last 3 years, we sell in the region of around £500 million worth of assets, and those typically will be those lower yielding properties. Last year in the London office market was a relatively low year in terms of ultimate quantum being sold. But we sold a £100 million stake in our 2 Finsbury Avenue development to Modon Holdings, who are a Middle East investor, earlier this calendar year. So there's liquidity in the market, but it's about finding the right kind of buyers and having the relationships to leverage that. So it's certainly something we hope to see improve over the next 12 months and continue to see the attractiveness of London spread around the world.